something to look forward to for the weekend for the family and for Gymmers, right?
Absolutely.
Well, a lot of people get famous for different things. You get famous for making $1 billion,
Right.
$1 billion shillings, or by becoming the king of squats. Quite something. He's been to Nigeria, other places, and he's now in Kenya.
You know, Wakaba, we always talk about the creative economy.
Yes.
And you always talk about the arts, entertainment. But this is one example of how an individual can turn something very ordinary into something that can be extraordinary.
That is quite major.
Yeah, absolutely.
Well, something for people to think about, especially as we talk about the big stories of the week, that being one of the things that has really trended, and literally showing what you're saying, that you can't cover niche anywhere in the market, even if it is simply creating a trend that people will want to follow, and you that get paid for.
Absolutely. You know, people underestimate, particularly at the time when unemployment is quite high.
Yes.
There's been a big push for how do you think about your competitive advantage? How do you think about that one thing you have?
Yes.
And how do you commercialize it in a way that is sustainable? I think that's now the big conversation, not just in Kenya, but across the African continent.
I'd like you to think about the branding that Luleko has been able to achieve. And then take stock of a really tall man, a guy from Western Kenya. And he's making money, but the brand, the way we've dealt it, totally different, two different worlds, and something for managers to think about, right?
You know, Peter Drucker, the business guru,
Yes.
said there are two main functions in business, marketing and innovation.
Yes.
So you can be very good in product development. Bradley,
Yes.
the gym guy, but the marketing is what really separates. Look at football, for example. One of the reasons the English Premier League
Yes.
has been more successful than the Bundesliga or the Serie A. They all play football, the same type of football, but the marketing around
The
it,
packaging.
the packaging around
Yes,
it
and
is the reason why most Kenyans almost will watch 90% of the time the English. So marketing is a very critical aspect.
Yes, like I've seen sometimes when you're under the weather because your team has taken a beating that weekend, but quite a bit to think about. Of course, biggest story this week, the Fed not cutting, slashing rates at the margin 0.5%, or as people like you would say, percentage points?
50 basis points.
Yes, 50 basis points. And this being quite big, a shock to the system. Why do you think they went that route rather than take it gradually?
Well, the market had predicted 25 basis points, but in the last few days, there was real major concerns about the labor market. And inflation was becoming less and less of a problem at 2.2%, when the target is 2%. But the labor market, especially in the cyclical sectors, such as restaurants, construction, things are really bellwether for the economy. Those really negative numbers coming through. So I think that really forced them to think through about a more aggressive rate cut.
There are those who would say that with the election coming up, the government needed to inject some positive sentiment into the entire economy, especially because people are thinking about things like the cost of living. They're thinking about things like finding a job. They're thinking about putting money on the table. They're thinking about college loans and things like that. Do you think politics played a major role in this?
That's highly unlikely. The Fed is an independent institution, and for them, they have two mandates. Number one, price stability, which has been achieved, and number two, low unemployment, which is becoming a problem. Now, there had been fears that the world might be getting into a recession. I did an op-ed on that on the Standard last week, really asking, are we heading into a recession? Because if you look at the August numbers, they were really, really looking really poor. So I think the Fed purely stuck to the data and they stuck to the science, and it was almost a unanimous. I think there's only one member who dissenting voice.
And so that is out there. Of course, across disease, this activities do crystallize themselves here. What do you think is going to be the likely impact, the likely outcome of this change in monetary stance?
Well, I think it should be positive for Kenya and most emerging markets. The capital flight that we saw last year might start reversing. So you might start seeing a lot of investors who had gone to the US for that high yield starting to come back to emerging and frontier markets. So we do expect to see African currencies, including the shilling, strengthening a bit. Yesterday we saw the shilling marginally strengthening quite a bit. We do expect the central banks here also to start pushing for a low interest rate environment, especially in Kenya, where non-performing loans are rather highest in 18 years. So I think this was a signal for a global easing cycle that's about to begin.
There are many who are asking, are we headed for the era of cheap money once again? We saw lots of innovation, lots of startups getting funding this part of the world because interest rates tended to be low overseas.
That's unlikely. I think the Fed has been very clear that their target rate is 2.8% in the long term. So I don't think we're going to go back to the 0% days of Alan Greenspan or Ben Bernanke. I think 2.8% is sort of like the long-term trend they're looking at. I think that's the sweet spot they might want to keep.
We've also seen Kenya finally start to get its act together in terms of formalizing labor relations with other countries. Over the years, we've had people export themselves so that Ken goes to school in the US, finds a job there, works for a few years, comes back, but literally no real framework that sort of looks at how you live, how you eat, how you engage with your employers from a country bilateral basis. Do you think the bilateral engagements we've seen recently will improve the lot of Kenyans who are out there in these economies?
Well, it's always good to have positive relationship with your partners. But if we are saying that our solution for unemployment is to export labor, I think it's a bit mistaken for two reasons. Number one, the world is in what it called globalization is in recession. Many countries are becoming more inward-looking, less open to migrants. If you look at Germany, for example, you have the rise of parties such as the FD, the Alternative for Deutschland.
The nationalists.
They've never won anything since World War II, but this year they've been able to secure seats in parliament. So it tells you the world is moving towards a less migrant-tolerant. If you look at the US, what Trump was saying about immigrants, you saw that.
And eating things.
So if your strategy is to try and export 250,000, 500,000 numbers there, this is not the time. The world is looking more inwards. Countries are asking about themselves. Are we creating jobs for ourselves? So it's going to be very hard to push that strategy right now.
So even as the US then tweaks its rates, while looking at the job numbers to sort of try and create a situation where manufacturing, where wholesale, retail, where other sectors of the economy can start to utilize this cash that's available as credit to start to create more jobs. Do you think Kenya is doing the same? Are we focusing on the right metrics? Are we pulling the right levers to start doing the things that you're saying?
Well, the problem is, let's start with the central bank. They did lower interest rates, but what we call the policy transmission signal is very weak. See, in the US, when the Fed makes an announcement that interest rates have been slashed, overnight, your mortgage payments go down, your car payments go down, your MBA loan goes down. In Kenya, it's not quite the same. The central bank can reduce the policy rate, which is the central bank rate, but out of the 40 banks today, only one has said that they are thinking about lowering interest rates. However, when the central bank increases interest rates, you can't go more than one day without getting an SMS from your bank that they're reviewing.
Why do you think this is the case? Especially because I know we've tackled this issue before. In fact, at one point, I remember the governor of the central bank was Njuguna Ndung'u, and the Barclays Bank MD in Kenya was the former CS. And I remember he said when we asked him, how come you're not following through with this decline in rates, because these chaps have said they might even go to 1%, to pull you and other banks down towards zero. He said, tell the government to lend directly to the market at zero. Very dismissive. Why does the central bank seem to, so to say, be held hostage by banks rather than the banks literally being able to follow through on the indicators that this one's put out?
Well, I think our policy rate is poor. The central bank rate is not effective. And we saw Professor Njuguna Ndung'u, when he was governor, he tried to introduce a different rate, the CBRR. But even then, it was quickly removed when the subsequent governor came in. So we've never had a strong correlation between what the central bank says and the reality in the economy. And that's why it's not a big event.
Yes.
Unlike in the US, when the world really stops, when the Fed chairman speaks, because it affects everybody's life. So I think we need to remove the central bank rate. The US use what is called the federal funds rate, which is tied. So every credit facility is tied to that. So an increase or a decrease automatically transmits. In Kenya, we don't have that strong correlation. So we need to think of a new policy rate that's actually tied to the loan that you're getting from your bank. Only then can you get the benefits that you should have been getting since the CBK reduced in Agatha. It's almost a month now and no change. So it tells you reforms now.
So then what you're saying is, because of this disconnect, would there be then other metrics internally? For example, sometimes we talk about the interbank rate. Sometimes we talk about several different windows that the central bank can operate that then are able to either put cash in or out of the banking system. And this would not only signal, they'd have a real effect on the metrics that we're talking about.
In fact, what you've said, Wakab, is what many commercial banks do. Many of them don't even look at the central bank rate.
Yes.
Many of them look at the 91-day T-bill or the 182 before they price to their clients. So the question is, then should we make then 182 and the 91 to become the policy rates, which is what happens in the US, where you have a target.
Yes.
The federal funds rate is a target.
Yes.
So if you say our target for the 91-day will be 10%,
Yes.
it means all these banks that use the 91-day as a benchmark have to move in tandem. So it has to be tied with a real indicator. You could use the interbank, but that would be very messy because it's a daily indicator.
Yes.
It'd be very noisy.
Yes.
But many banks use the 182-day, which is a 6 months indicator. And I think that could be a much better policy rate than what we have right now.
Wouldn't that then leave the central bank at the mercy of other exigencies of the market, knowing that sometimes government can be hard up for cash and will put out a bond midweek and say we need to bring in this cash, come rain, come shine, and jack something up that day to fill in a different hole like we've seen recently this year. So would that be effective? Or would we say that...
That's a really good point. Sometimes our fiscal policy concerns can come and overtake monetary policy. We actually call it fiscal dominance of thought. I think the cure for that is the people who own fiscal and monetary policy need to be aligned.
Seated in the same table.
In fact, Wakabi, if you go to many countries, there is a minister for economy who's very different from the minister for treasury and finance. And this minister of economy is supposed to be the person who brings them together and says, can we be reading from the same script? Because what you've just described is a huge, especially at a time when there's a huge cash crunch and the government needs to borrow. That can really escalate interest rates at a time when the world is trying to lower interest rates.
More seats for CSs in Kenya, so to say. Let's move on to something different. We've seen recently attempts to reform the bond market here in Kenya. You and I have had the conversation before about the collapse of the corporate paper thing, especially after what happened with Chase and other banks. Do you think this will turn this situation around? Are we going to start a nascent rise of the bond market again?
Well, it takes time to rebuild that trust because episodes of like what you've described are what keep people away. The reason government bonds, infrastructure bonds are very popular is because they have the fast charge on the exchequer, which is not something corporate bonds enjoy. So until some of those legal entities loopholes are reviewed, then there'll still be that skepticism. Then number two, most of these corporate bonds are tied to also the sovereign rating of the country, and that, as you've seen over the last 2-3 months, has indeed taken a beating.
Yes. So when it comes to corporate governance, and for me, because this directly speaks to the risk you're talking about, do you think we're at a place where we can talk about being accountable to the market, being accountable to shareholders, being in a place where the internal workings of the company and disclosures are visible to the investing public in a way that enables them make accurate, timely, and decisions that will work for them? Do you think the people who would be coming to the bond market can be described in that way in this country?
I don't think we are there, Wakaba. And funny enough, Kenya is probably the one country that has the most MBAs probably be in Africa. But for some reason, those lessons don't really filter into the corporate world as you'd expect. I think it's a journey. We've seen various initiatives coming up from the private sector, the blue movement. There's a lot happening, but I think we need to go almost 3, 4, 5 years of solid reporting before investors can say, I think Kenya has gotten it right, because we are seeing huge companies still struggling with that area.
In 30 seconds, even as you say things like that and hope to move in that direction, we've seen minority shareholders go to the press, say we were promised this sort of growth, these sorts of returns, nothing yet. Is that what we are talking about? Do you think we can open up that space a bit more to give power to the investing public and to the regulator to be able to shine a light?
It's part of investor information, investor education. A lot of minority investors, as you've read in the papers, don't even know the assets that belong to the entity. So I think it's a time for investor education. The legalities also have to be clarified. I think there's a lot of gray areas in our legal system towards investments. But I think if we can go that direction, we can definitely make a much better investment environment.
Thank you very much, Ken, for your time. It has been a pleasure. Well, that's where we bring KTN Business Today to a close. Of course, the news continues here on KTN. We, of course, will see you again at 9 p.m. for the KTN Prime News for Business. But until Monday, it is Kwaheri ya Kuonana. Do enjoy the weekend ahead. My name is Peter Wakaba.